What's up, everyone, and welcome to the Long Game Podcast hosted by Thomas Kopelman and Jacob Turner. In each episode, you'll hear us break down financial topics that are relevant to you and your situation. Our goal is to help bring credible financial information to you in short, bite-sized episodes.
All opinions expressed on this show are for educational, informational, and entertainment purposes only. Nothing on the Long Game Podcast should be considered advice. Always consult with your team of professionals before making any decisions regarding your finances.
All right, what's up, and welcome back, everyone, to another episode of the Long Game Podcast. I'm your co-host, Thomas Kopelman, here with me, Jacob Turner, my other co-host. Jacob, man, I'm excited to be back with you and doing a solo episode.
I always love the solo ones. I feel like we can get the most actionable information for listeners out there.
Yeah, me too. And I'm excited about this one. Obviously, both of us really focus on business owners. I know that you still have like the spin with athletes and, maybe that their regular salary is not necessarily a business owner, but really, I mean, they are all business owners in some way outside of that. So I feel like obviously this is something that we see in our day-to-day lives with our businesses and all the people that we help with. But I don't know about you, I see so many mistakes that business owners are making. And the more and more I work with business owners, the more that I'm really talking about the same core principles. And so we thought it'd be really helpful to do an episode, really just kind of walking through the 10 biggest mistakes that we see business owners making. And so, Jacob, I'd love to kind of have you start this off and, list one of the ones that you see commonly.
Yeah. And the other thing I want to preface is, Thomas, you mentioned this, but you and I both focus on business owners, and we see it time and time again. We have all these reps seeing a lot of the same things over and over again. And one thing that I've realized, even some of the smartest business owners we work with, they haven't been made aware of some of these missteps because there's often not a place that they're going to that they're talking about these things. There's groups out there like Entrepreneurs Organization and YPO and Hampton where they're talking about how to build their business, but there's often not places for them to go and be talking about what are the pitfalls I might be making financially in my business. And oftentimes they never come up for water and they actually see like, is this thing actually translating to my personal financial life? So with that, the first one that we had on here was just holding too much cash in the business. And I think ultimately, a lot of times I personally feel like this just comes from a lack of planning. They don't really know what to do with the cash. So they go from, you start the business and the first thing you think is like, okay, I want to make some money. You make some money, you start hiring people. And then you start thinking, okay, I want to make payroll. And then once you start doing all those things, you think, okay, I want to start growing the business. So you're saying, I'm going to keep some money in the business so I can start growing the business. And before you know it, you're 2, 5, 10 years down the road, and you have hundreds of thousands, if not millions of dollars sitting in your business, oftentimes earning next to nothing or nothing. And you've never really thought about what I should be doing with it. And I think the other thing, and I'd be curious to hear your take on this, Thomas, is I've talked with a lot of business owners who also get confused about what is the basis of the money I have in my business. And by basis, what I mean by that is how much of the money, if I pulled it out tomorrow, would I actually be taxed on versus how much have I already been taxed on?
Yeah. I mean, I think there's two parts to this. I think I see a lot of business owners that have too much cash where they, for one, maybe they just think that it doesn't get taxed unless they take the money out, which again, really only applies to C Corps, and most businesses are not C Corps. But then I also see a lot of people that don't hold enough cash. And we all see the statistics that like 98% of businesses fail because of cash flow, but like, duh, right? Like the only way to really fail your business is because you didn't make enough money and you don't have money left over. So I think this is like twofold. Like you want to find that balance of we have an emergency reserve, we're saving for the things that are really important to us, but above that, we're not holding too much or too little. And I think one thing I see is almost nobody that I come across is holding their business cash in anything that has a yield. I've sat down with 3 clients in the last 2 weeks that have anywhere from $300,000 to $700,000 in cash. That's a pretty easy, $15,000 to $35,000 of interest just by parking it somewhere different. Like to me, that's a no-brainer. I love sitting down with a client and being like, hey, I guess you didn't notice this, but you can go make 3 times my fee by just me pointing you to the right high yield savings account. Like that's a really big win. I think what was your question that you had again?
Well, let's stay on that topic for a second. What are some of the best options you feel like out there right now for business owners for the cash that's in their business? Because Thomas is spot on here. Like if we were having this conversation 3 or 4 years ago, it wouldn't be that big of a deal. But with where interest rates are today, it's a huge deal. And we're talking people are leaving tens of thousands of dollars on the table because they haven't made a decision to have a business account that's earning interest.
Yeah. I mean, for me, I use Flourish. So it's like really a bank account only through advisors. I don't get anything out of it. Like I don't pay anything to be on it, but it pays 5%, pretty good. FDIC limits are pretty high. I think for other business owners, sometimes it's good to just, put it in treasuries or money market funds. Like a lot of times that is really simple to do as well. To me, I mean, I don't really care if you're optimizing from 5.2 to 5 or 4.75 to 5. Like at the end of the day, it's like get it to the right place, leave the right amount there, don't really think about it, go back to living your life, which this is not on our list, but this really got me thinking about this is like I've worked with a lot of business owners who simply never think about finances. Like they run the business, they make sure they get paid, they don't think about how much cash is on hand, they don't think about their personal finances, they don't think about tax planning in their business, they don't think about retirement accounts, they don't think about how to structure equity and pay bonuses, etc. Like I get it, running your business and growing your business is priority number one. But as a CEO of a business, you do need to carve out time to think about the finances, or you need to hire somebody to do that for you. You really have no other choice.
Yeah, I couldn't agree with you more. And I think it's probably the most common thing I see with entrepreneurs. And it doesn't matter what level of success they have with the business. It's a common mistake because even as a business owner myself, you get so caught up, you get so focused on doing the next thing in your business, and whether it's growing revenue or figuring out how to serve your clients better, figuring out what the next solution or next thing is going to be, or the process that is going to solve all your problems, that you never look up and you say, I just want to make sure that this is reflecting back to my personal financial life.
Yeah, totally. Okay, let's move to the next one. So next one I have is just not planning for taxes. And I think there's like a couple interesting points here. I mean, like just in this, I brought on a bunch of new clients in Q1, and like I just look and I'm like, hey, why do you have all this cash in the business? And they're like, well, because for taxes, like how much are you going to owe in taxes? Like I really have no clue. Which is why we do like tax planning is so important. Quarterly estimates. What's your liability going to be? What's your liability going to be if you do max the solo? If you do put money into the SEP, etc. But like just winging it and having either a ton of money in there, or what a lot of people do is they're actually like spending it. Like they're paying themselves, they're spending it, they're doing things in their personal life. And then they're like, oh gosh, it's January. I get a tax estimate. I owe $200,000. Well, now I have to take all profits from the business in Q1 to get back on track. And then now I'm behind track for the next year because all of those 3 months had to be from prior years. When to me, the biggest thing is get ahead of this. Like you should be saving monthly, quarterly, et cetera, to be on track for taxes. So you're never playing catch up. Like there's so many clients we've helped with this, and then they walk away and they're like, oh my gosh, like for once tax time isn't brutal because we're not figuring out how do we find every last dollar to be able to pay the taxes that we owe. And then what happens is they don't think about it and they do it again, and then they do it again. And when you can get out of that, I promise your financial life is going to feel significantly better.
It's almost as much as it's a tactical strategy thing, it's almost a total peace of mind thing where I think a lot of the business owners that we've worked with, there's stress around tax season because it's the unknown of I have a bunch of money saved, whatever a bunch of money means, but they don't know what they're actually going to owe. So even if they have a couple $100,000 saved, they don't know if they might have to come up with another couple $100,000. And they're thinking, well, I just had a great year. And if you ask them, what's your safe harbor or what have you paid in quarterly estimates, 99% of the time they have no idea. And I think the biggest key is just making sure that they have somebody that is being able to articulate to them in a really simple terms. Here's what the tax bill is projected to be. Maybe not down to every single penny or every single dollar, but a ballpark figure. Here's what we've paid in quarterly estimates. Hey, we know we've reached our safe harbor, so we're not going to pay penalties. That just gives a ton of peace of mind.
Yeah, we've done a lot this year to try to enhance like our systems around this to be like, I ask clients all the time, like, what did you pay in quarterly taxes? They're like, I have no idea. And so luckily their bank accounts are connected to Right Capital. We can go look through it and go find those estimates. But like we've done a lot to be like tax loss harvesting. Let's make sure that gets noted. Charitable giving. Let's make sure that gets noted. What you're paying in quarterlies, what your safe harbor number is, like having that all organized in one place, whether you work with a planner or you don't, is really important. So, you don't get around to tax time and you're going back through all your bank records, just trying to find the IRS tax, like that part in your financials, because it's annoying and it's scrambling. And then you're like, hey, you have a $120,000 tax bill. And you're like, wait, do I owe 120? Did I pay 60 in quarterly? Do I owe 60? Like you just need to get better organized on tracking all of those things that are happening too.
I think that flows really well to our third topic on here, but not waiting until right up to the tax filing deadline to start doing tax planning. The reality is, as we both talk about a lot, taxes is a lifetime game, and we want to make sure that we're optimizing for taxes. And the way that I always think about it is the IRS will set the rules on what the tax code is. They're going to tell you essentially what you're going to have to pay. But then it's up to you to say what strategies, what tactics, what things should I be thinking about that are important to me to help lower my lifetime tax bill. And I think that's the number one thing that I see with the entrepreneurs and the business owners that come in that we can help optimize in their situation is planning around taxes. And oftentimes I don't think most of the folks that have come in and worked with us have ever had anybody truly doing tax planning, because it's not that they don't have great CPAs in their life, but the reality is most CPAs have thousands of clients. So to get proactive tax planning from most CPAs, and this is a generalization, you're going to have to actually be going to them and booking meetings and saying, hey, I want to go over this topic or that topic. Whereas having somebody on and pay them a bunch, right? And make sure that having somebody on your financial team where your financial advisor is really coordinating all those aspects and doing the tax planning, I think can be a huge value add.
Yeah, and I'm not hating by saying and paying. I'm just saying, like, don't expect to pay for a return and get planning, right? Those are just misalignments for you. Like, there are CPAs will do tax planning. There's plenty of CPAs you can reach out to and say, hey, I'd love to be more proactive in our tax planning. Like, do you have a model for this? And most of them do. But what I found is that a lot of them struggle to sell it. So they don't even really bring it up unless somebody else does. Like, we do the tax planning, you do the tax planning with your clients. But I think for people who don't and you have a CPA, like, find one who's going to do it, or find a financial planner who's going to partner with the CPA who's going to do it, because proactive tax planning is really important. But I think on this point, it's that, like, you lose so much of tax planning if you wait till after December 31st, right? We did a podcast episode of this, the things that you can still do starting in January till tax time. It's very, very limited to relative to what you can do if you start planning in October of the year before, or the actual tax year of when you're going to be taxed. I think that's the important part, is be proactive. Okay. Next one is not thinking about tax election status. So I think, again, people get really confused. They just think they're an LLC, when an LLC is like the legal entity you are. And then there's this tax election. So you can be an S Corp, you could be a partnership, you could be a C Corp, you can be a sole prop. And at the end of the day, the one that you want to be changes based on your situation. If you're probably not going to be that profitable for a while, you're going to take on a lot of investors, you're going to build a tech company, generally you're probably going to want to be a C Corp. If you are a service-based business, you probably are going to want to be an S Corp or a partnership, right? If you're going to own real estate inside of it, you probably don't really want to be an S Corp. But this is something that people don't really think about. And so they're like, hey, I should be an S Corp, right? Like, this is going to be really great for me. But in all reality, maybe an S Corp isn't the right thing, because now you're paying yourself $70,000 salary. You take $10,000 distribution. You're like, great, I'm going to save 15.3% on 10,000. But at the same time, you also reduce the qualified business income deduction, because you reduced your profit from 80 to 10,000, right? And so you really have to dig into this and make sure you're doing the right one and you're thinking about the right one, because it's not always easy to just elect S Corp because somebody said to you to do it and then backtrack to a different one. It's easy to go from S to C, but it's not really easy to go from S Corp back to a partnership.
Yeah, I think it comes back to making sure that you have people that you're communicating with, what your plan and what your strategy is, not only for today, but also for the future. And oftentimes I think people see one article, they see one post, they see one video online about how an S Corp could save them money on taxes. And they think, well, yeah, I need to be an S Corp. And the reality is you need to figure out what you're trying to accomplish in your business first and foremost, and then talk to somebody about, if this is what I'm trying to accomplish in the next 1 to 2 years, what is optimal for me today? And then if this is what I'm trying to accomplish in the next 3 to 10 years, what would potentially be optimal for me down the road? So then you have an idea of, like, what does that transition point potentially look like? I know for me, as an example, like, we started as a partnership. And the reason why we started as a partnership was it gave us way more flexibility. It gave us a ton of flexibility on how we wanted to take money out of the business, what we wanted to keep in the business. We didn't have to have set W-2 salaries. And then we transitioned to an S Corp when there was enough money there where it was like, okay, this makes sense to do this. We're going to be saving on some self-employment. But I think it's really important to understand what you're trying to accomplish, because another example is, if I was building a tech company and I was saying I'm going to take on a bunch of shareholders and I want to have all this money that I can make sure that I keep in the business, a C Corp makes a ton of sense. And then you can do QSBS, where you're really looking out and saying, what am I trying to accomplish with this business? And then backtracking and saying what makes the most sense today. And then also just not getting ahead of yourself. Thomas, you made a great point about this idea that people want to become an S corp, and then they're going to take a $60,000 or $70,000 salary and take 10,000 in distributions. And they didn't have the idea wrong, but they just moved too fast. They should have waited another year or two when the salary and the distributions were going to be a lot higher.
Yeah, and I think the 3 to 10 year time frame is really important, right? Like, sure, what if this year moving to an S corp is going to save you $3,000 in taxes, but 5 years from now, that's going to be the worst decision for you, right? Like, I think sometimes people make these quick decisions to save a little bit in taxes when in the long run, it's going to hurt you way more. And so I think you really do need to think beyond 1 to 2 years and what's going to happen right now.
Yeah.
Cool. What next one do you have?
So the fifth one we have on here is QBI. So QBI stands for Qualified Business Income. And QBI is the single greatest tax planning tool available to most business owners out there. QBI is available to essentially everybody outside of C corporations. So anything that's a pass-through entity, you're going to be able to maximize QBI. Now, there are some restrictions around that. If you're an SSTB, which is essentially a service-based business. So Thomas and I both run service-based businesses. So technically we would qualify as an SSTB. So there's additional rules that apply. But what I will say is that if you don't understand QBI, if your tax planning partner, whoever that is, whether that's your financial team, whether that's your CPA, is not talking to you about QBI, you need to make sure they're talking to you about it. This is something that we've saved clients on a net basis. We're talking $150,000 to $200,000 in taxes where they actually got that money back, right? We're talking $600,000-$700,000 in potential deductions for some of these business owners that are making a ton of money. And it's really important to understand what it looks like because we talked about tax election status. Once you figure out tax election status, especially if you're going to go S corp, which is the most common, then you need to figure out what is that potentially salary going to look like versus what is that distribution going to look like. And Thomas, I'd love to hear your stance on how you help entrepreneurs and business owners plan around this at the beginning of the year when they don't totally know what the salary, what the total income is going to look like at the end of the year.
Yeah. I mean, I think when we talk with CPAs too, it's very split. Like there are a lot of CPAs who say, pay yourself whatever you want from, distributions that you need throughout the year. And then let's run like one payroll at the end of the year to optimize. I don't like that strategy because for a lot of the people that I work with, like I actually work with a lot of high income earners that are not SSTBs, which I think surprises people because doctors, lawyers, financial advisors, anybody where it's like your name and your image is the reason why you have a business and the reason why you make money doesn't qualify. But there are still, I have a bunch of other like small S corps that do not fit in that boat that do get the qualified business income deduction. And for some of them, like to maximize their salary is like 285,000 plus. And so it's like, that's a really big payroll to run in December. So what we do is we say like, look at last year. How is this year starting? Is it trending the way that we want it to go? If so, let's get you close to that ideal salary. So let's say you were going to have $1 million in profit. So the ideal salary is 275,000. Maybe we're going to get you to like 150 to 200 throughout the year. And we can still track at like the end of Q3. Like, does that still look like the right amount? Are we gonna have to pay yourself less? Or are we gonna have to pay yourself more? But it's really not that easy to do because retirement contributions reduce it. How you do in December changes it. And so like you have to be like making these decisions pretty late in the year. Like we have some clients who do like 20 to 30% of their revenue in December alone. And so like you're taking best guesses and you're fine tuning with like a one-off payroll on, the 29th of December. But you're right, like fine tuning it makes a really big difference. Like we had a client who came in, he had a zero salary as an S corp, and he was basically at the point where it's 50% of W-2 wages or 20% of business profits, whichever's lesser. So he was getting $0 qualified business income deduction on $1 million of profit. The difference of paying himself the right amount and then adding in a solo 401k is like 100,000+ in tax savings. We didn't really do anything other than pay him differently. And these are the stories where like I really, really love, because in general, what I see more often is like they're paying themselves $75,000 to $100,000. That's what they think the best move is, lowest salary, when there's less than the person at zero, but you can still have so much in tax savings going from that 75 minus the retirement contribution to the ideal salary. And it's just something that people aren't talking about. People don't think about. Most of the time you engage with your CPA in, February or March, you can't make these changes because it's after the calendar year. that like this is where the proactive tax planning actually becomes really important, is plan in the beginning of the year, track in the middle of the year, optimize at the end of the year. And you can get really close. Like for us, we're within 1,000 or 4,000, of that amount. And that feels pretty good, right? Because for these people who have 200,000-300,000 of taxes, like missing out on 1,000 or 2,000 is just how it's going to be. There's really no way to make it perfect.
Yeah. The other thing I would say for people listening out there is you want to make sure that you're optimizing for this stuff. And the reality is you don't need to be the expert on it, but it does really pay to come and ask these questions, right? So whether it's your financial team, whether it's your CPA, ask the question around, is there anything else I could be doing to optimize this situation? I heard this term, I heard QBI, I heard self-employment taxes, whatever it is, and making sure that they understand, hey, I'm willing to do the extra step if I need to do an extra step to optimize my tax situation. Because a lot of times, for better or worse, there's a lot of people out there that they're not going to bring it up unless you bring it up. So you need to take responsibility for this. You need to ask the people that are on your team. And frankly, if the people aren't being proactive and they're not doing their job, you should probably look for a different team.
Yeah. Yeah. No, I couldn't agree more. So next one is not optimizing retirement accounts. So this is something I see really common. Like first mistake around this is just not using retirement accounts, whether they just pay themselves and use it elsewhere. I just don't really get this, because even if you're like, I would much rather have flexibility, I just don't see why you wouldn't do like a Roth retirement account anyways. But first one is, not using retirement account. Second one's using the wrong one, right? Like something that we see all the time is like people using SEP IRAs when in reality, solo 401ks are going to give them a lot more, right? Like if you made 100,000 a SEP, you can only do 25. If you have a solo, you can do the 23,000 this year plus 25% of that comp. So you can actually end up doing 48 versus 23 at that same income limit. The other one I see is like business owners with employees having SEPs over regular 401ks because everybody thinks they're expensive, but there's plenty of great low cost options now for 401ks. And so what they do is they have a SEP, they make 100, they have two employees, one makes 80, one makes 50. And they're like, well, I don't want to really put any in my SEP because I have to put the same percent of the income to my employees. So if I want to max my SEP with 100,000 and do 25, well, that 80,000 employee, I have to put 25% of their income. And then the other employee makes 50, I have to do 25% of their income. So now I don't really want to do it. So that's obviously a huge mistake. So then 401ks, but really on this one, it's just like, make sure you have a retirement account and make sure that you have the right one that not only I think benefits you, you can put the most away, but is also realistic in a way that you don't, not use it because you set up the wrong one because you're scared of having to pay so much to somebody else.
Yeah, a couple things that I would add. I mean, I don't understand. I do understand why business owners sometimes don't set up retirement accounts. And I think a lot of it stems from one, they think that there's going to be a significant cost involved with it, which nowadays the cost has come down a lot. Plus there's a $5,000 tax credit you can get for essentially reasonable expenses on setting one up. So there's really no reason not to set one up at this point. The other thing to think about is you want to make sure that you're optimizing for your situation. And I think a lot of times the business owners are afraid of the fact that if I put money in this retirement account, I'm not going to have access to it. And I've been in the situation not that long ago where I was the business owner and you're thinking my cash flow is great. And every business owner's had that idea where they've been in that pinch from cash flow. So they think like, if I put this money in this retirement account, am I not going to be able to take it out? So you really need to make sure that you're optimizing for your own situation. But Thomas, like you talked about, without doing this, you're leaving a ton of money on the table.
A ton. I mean, again, to me, it's just like you're either deferring and you're deferring at a really high rate, or you're blocking in taxes and never paying taxes again. Like to me, I always prioritize those accounts first for super high income earners. Like there are plenty of people that should just do the match. They should go do their Roth IRA and other things. But for most of the people that we work with that are really high income earners, they're investing significantly more than these annual limits per year. Starting there and getting those tax benefits is really big. Okay. What's your next one?
Creating diversification outside of your business. And the way that I describe this is we want to be throwing money over the wall. So one of the biggest issues that I see with business owners is they invest every dollar back into their business, which makes a lot of sense. Like that's the one thing that they know. And even when I talk about investing, I often say like you should invest in things you know. And the business is the one thing that they know. But what happens is over time, they just continually pour money back into their business. And then what happens is they're 5, 10, 15, 20 years down the road. And the only way for them to continue living the same lifestyle they're living is for them to sell at the perfect number at the perfect time for the perfect multiple, because they haven't created any diversification outside of their business. Whereas the other solution, and the more optimal solution in my mind, is they throw money over the wall. They have some sort of money saved aside, and then they can really have the optionality to say, do I want to keep pouring money back into this business? Do I want to scale further? Do I want to, pull back in the business? But it just creates so much more optionality by doing that.
Yeah, I think this is a hard one because I see both sides of this. I see some people that never diversify. They keep every dollar in the business. They keep investing in, and like you're one bad year or like one fumbled, thing you bought and sold away. But I also see some other people who are a little too scared to invest back in their business. They take everything away, they diversify, and that's great. But like I can think of a client I have, for example, who like they have a product, they do really, really well. And based on what they invest into ads, they have a set return of what they make. Like we have years of data on this. And let's say, last year they did 12 million in revenue and they profited 2, right? Well, this year it's looking like they'll do closer to like 16 and profit like 4. And so we can take a lot of money, invest elsewhere, which we're still doing that, right? Like not everything's in the business, but they know for each amount additional that they invest, that they end up getting like 40 to 50% return on what they're doing. It's like, yeah, you don't want to over allocate to that, but it's really hard to say, go put this anywhere else when you have years and years and years of data showing that that's like at least what you can expect per dollar spent on ads. So I think you do need to analyze this in multiple different ways.
Yeah, it's actually one thing that I've struggled with personally, investing back into the business, because I've been so used to investing in whether it's the market or real estate, where you're seeing almost, I don't want to say an immediate return because that's not fair, but if you invest in an index fund, right, and we hold it for 2 years, we both know the odds of that fund going up, right? And I'm going to be getting dividends and things where I can see this tangible benefit, versus a lot of times in your business, it sounds like your client has a bunch of data, but oftentimes when you're trying a new investment, you don't have that data, and you're saying, I think this is going to work, but I also don't know. And I think any business owner that's owned a business for any period in time would say that they've certainly put money in their business that they have not seen a return on. So it's making sure that you're optimizing for what you're trying to accomplish. But I think to your point, Thomas, it's spot on. You can't be scared to invest back in your business, right? This is the one thing that is going to ultimately drive your income. By driving your income, that's the one thing that's going to really help build your wealth in the future.
Totally. So next one is getting complicated, or like kind of maybe even doing different jobs outside of what their main thing is. And this is actually like something I talk about with business owners a lot, is they have this one thing, their business, that they make significant money in. Like, right, their hourly rate, basically, if you look at, hey, you make $1 million a year, what your hourly rate is, it's pretty good. It's really good. And what they do is they start doing multiple other things. And so they're like, ooh, this interests me, I'm going to do that. And then like, I'm going to sell this, and then I'm going to do this. Right. And like, I think there's a couple points to talk about here. I think you have the right to do that. And I think sometimes it is the right thing to do. Like I even personally, like, we do some other things. Like we're selling financial courses. We're doing some courses for financial advisors on marketing. I do some one-off consulting, but to me, I really enjoy it. I think it adds a lot of value to my life. It doesn't take away from my business. Like it's not slowing down client growth. It's not slowing down the business growth in general. And it's something that's fun to do, but I know 98% of my time should be in the business. But then I think there's people who get too distracted, right? And I think, part of building wealth is having the option to just pursue the things that you want to do. But I think you do still have to have that reality check and say, I'm really good at this. We're making really good money. I still have wealth to build. How do I stay focused in that lane where I'm not just like distracted by the noise and all these other things? But I think that, what you enjoy still has to be a part of that.
You got to keep the main thing. But even for you, Thomas, in your example, you're doing things that are an offshoot of the main thing. Where I think I see most business owners fall into a trap here is they do something completely outside of the main thing because they thought it was cool, or they were around a campfire and somebody told a story around it, and they thought, well, I have the money, I'll go invest and do that thing too. And then all of a sudden it's starting to take away time, and starting to take away capital from the main thing that they're the best in the world at doing. So just making sure, if you're a business owner out there, understanding like, what is the optimal place for me to put the capital, both my resources as financial capital, but also my human resources, my time.
Yeah, I think it's funny. This kind of goes hand in hand with like people hating on the athletes for having podcasts. And they're like, focus on basketball. Why do you have a podcast, Duncan Robinson? It's like, what is the guy going to play basketball 14 hours a day, every day. Like he could hop on for an hour and talk. Like it is okay to have some activities outside of what your main thing is that bring you happiness and enjoyment. But that kind of goes hand in hand with our next one.
Yeah. So this one is actually something that I wrote about in my newsletter, but it's this idea of creating the perfect day. And one of the biggest struggles I see with business owners is their first goal in their business is usually to support their lifestyle. And then it's to make a little bit better lifestyle. And then maybe it's to support their employees. And then maybe it's to really grow this business. And then they get so far down the road that they forgot what they're even trying to accomplish in their personal life. And they're just head down on the business, which isn't always a bad thing. But I think it's really important to make sure that you come up for air and you understand, what is my perfect day? What I mean by that is, if you wrote down on a piece of paper, if I woke up at 7 o'clock in the morning, what would you do? And then what would you do at 9? What would you do at 11? And what would you do at 1? And what would you do at 6 o'clock at night? And what would be an element of your day that would be challenging, but you would enjoy it? And what would be an element of your day that would be relaxing and you would enjoy it? I think that exercise alone can really help business owners get clarity around what they're trying to accomplish in their business.
Yeah, I mean, I totally agree. And I think this is something that we hit on really well a couple episodes ago with Michael. But, I think it's as much as you can align the things that you enjoy. And I think the more that you make the business be something that you enjoy and the more that you stay in the roles that you enjoy, the more successful that it's going to be. Like I work with some business owners who they don't do this, right? Like they just, you do this, I'm going to do that, even though that's not at all what they want. That's not at all in their best lanes. And I think that, they could be better off if they actually took the time and carved out and said, where should we be? What does that leave for us to hire? What are the types of people that we need to put in those positions? And then seeing where that would take their business. In my experience, that's what I've seen is the most successful businesses do that. And they do that really well and really, really intentionally.
Delegate to elevate. All right. So we've talked about 9 concepts that have to do with building and growing your business. And it looks like the last one is on exiting. So why don't you talk about that, Thomas?
Yeah, I think, the mistake I think some people make here, there's a bunch. I think one of them is just like not really having a clear goal on what their exit is. And I think for us, when we start with business owners, it's always one thing that we think about is like, do you plan to exit the business? If so, when? If so, what's that price that you would consider it? Because I think sometimes people don't think about that. And so they either kind of get like, the syndrome where they see this dollar amount, they're like, gosh, I'm going to sell it. And sometimes you're taking money off the table too soon when you're in a really great phase. And I think other times people don't think about it. And so then like, they don't even want to hear offers, or somebody brings an offer and they don't know if that's good or if that's bad or if they should accept it. And then the other thing I see is that just people not understanding if their business even is exitable, right? Like for a lot of service-based businesses, you are the business and your business is not sellable, right? Like I think, we're lucky financial planning clients stay. So like generally you can get pretty good multiples and you can sell it. But like if you're a marketing agency and you have 3 clients and you have no employees and you do $1 million in revenue, you're not going to get a 4x multiple. You're probably not going to get a multiple at all. And so I think just getting clear and understanding that. And then, the last part is like, if you're going to exit, starting to think about it and starting to think about the planning around it. Cause again, like entity structure, QSBS, the way that you can package it, how important it is to harvest losses, all of those things are really important as you get 5-ish years away from an exit.
The best decisions that I've ever made always start with the end in mind. And it's a line I use all the time. And I think it's so relevant when I think about exiting a business, because if you don't know where you're going and what you're trying to accomplish, you don't know what steps you should be planning for now. And Thomas, like you talked about, there's really endless steps a business owner can go through, from estate planning to cleaning up their books to making sure that they have processes in place. One of the best books I've read on this is Built to Sell. And it's a super simple book and actually goes through a marketing agency. So a service-based business, and it says, how could a service-based business sell without the owner staying on? And it walks through how you create a productized offering and how you create services. Then you create processes around those services. And it's just an incredible resource for business owners out there. But the number one thing is understanding what you're trying to accomplish in your business.
Yeah. And I think before you wrap us up and kind of take this out, one that we didn't hit on that I think is always important, whether it's business or personal or whatever, is just not taking action. I think that's one of the biggest mistakes I see people make, is they're just like, They have all these options. They overanalyze, they think and they think and they think, and they never take any action. And I think at the end of the day, you don't get anywhere if you don't take action. And so like a lot of times a step in the right direction is better than no steps trying to find the perfect direction.
I love that. You can have all the information in the world, but if you don't take action, it doesn't matter. Guys, that's the podcast. I appreciate everybody joining us. Make sure you like and subscribe. Me and Thomas are putting a lot of work and effort into these episodes, and we want to keep making them better for you. And we only ask that you like, subscribe, and share the show. So until next time.